Good morning. Thank you so much for joining us today. We are going to talk about the tax reform for business changes specifically. Last week, we had a webinar on how tax reform affected individuals. And if you missed that, you can email us and we can send you a link for that so you can catch that last webinar that we had. But in the meantime, my name is Misty Wolsfeld. I'm a tax preparer here at Admin Books. On the line, we also have Renee Daggett, the owner of Admin Books, and Sabrina Wilcox, a CPA with us. Now, this is the largest tax reform that we've seen in 30 years, and we want to educate you on all the changes that you could expect to see. In this specific webinar, we want to, again, educate you. We want to give you the ability to make decisions so there are no surprises come tax time. But then also, we just want to make sure that this webinar is fun. We want to talk to you in plain English so you understand what you need to understand in order, again, to not have surprises. As always, please consult us, consult your tax professional if you have detailed questions that are specific to your situation. Now, who is Admin Books? We are a California accounting firm. We specialize in taxes for individuals, corporations, C Corp, S Corp, partnership, any taxes, we do them. We also support our clients with QuickBooks Online bookkeeping. We do payroll. We are a one-stop shop. We are also a team of 14. We have 6 in the California office, and then we have an additional 8 people spread out throughout the United States. So we are very adept at working remotely. And part of that remote work ability has led us to being named with Intuit as one of the top 15 firms of the future. We were so lucky to receive that distinction from them. Again, top 15, and that was from a pool of candidates within the United States, Canada, the United Kingdom, and Australia. So again, very honored to have received that distinction from them. Now, today's speaker, Renee Daggett, is, again, the CEO of Admin Books, and Renee has the heart of a teacher. She is eager to educate everyone on the new tax reform. She takes care of every individual person as if their situation were her own. And so it's really important to her to make sure that everybody has the tools they need to make informed decisions for their future. Now, I want to talk about, let's see here, we have housekeeping items. So I want to mention that you are in listen-only mode. And we do want this to be interactive. So please use the chat feature if you have any questions. There's also a PDF in that control box that you can click on that will give you the handouts for all of the slides that we're going to discuss today. And as far as we need to tell you, this session is informational only. It is general purpose information. This is no way to be construed as specific advice for your individual tax situation. And we strongly encourage that you reach out to your tax preparer and have a conversation about your specific situation.
Well, thank you so much, Misty, for that fabulous introduction. I appreciate that. Good morning, everyone. My name is Renee, and I'm so excited to share with you the new changes that are coming this year. We're going to be talking about the general changes that affect all businesses. So what this means is meals, entertainment, the new credits that are available to businesses, accelerating deductions for assets, limiting some pay for executives. We're going to talk about some lower brackets and an overview of the 20% deduction. We're going to talk a couple things on specifically for C corporations and specifically for partnerships. But I also want to talk about how these new tax law changes are going to affect your entity. And perhaps you may want to consider changing your entity in order to reduce your taxes. So let's get started. So I'm going to first talk about changes that have come about for all businesses, regardless of your entity. So bonus depreciation is available for assets that you purchase. Now, actually, this started last September 2017. Now you can deduct 100% of those assets that you purchased back from September 2017. The old rule required you only to deduct the 100% for new assets. So you have to buy a new vehicle, a new desk, a new computer. But this has now changed, so now you can deduct used property. Last year it didn't qualify, and now it does, so keep that in mind. Last year, businesses could write off up to $500,000 of assets, and now that is bumped up to $1 million. So that's a great thing. But the IRS clarified that it now includes deducting roofing, HVAC, fire, alarm, and also furnishings for a rental property. The new rule now talks about businesses can deduct for having an energy efficient building. So if you're building a building, adding energy efficient items, there is a new deduction for that. If your business had a loss, the old rule was that you could take that loss and apply it to profits in 2 years back on your returns or 20 years forward. The new law now says that you cannot carry it back 2 years. You can only carry it forward, but the good news is you carry it forward indefinitely. Over the past years, there's actually been some people in the news, I'm sure you're aware of. They have either been accused or convicted of sexual harassment, and this is actually a terrible thing, but the IRS has something now to say about the payouts that businesses are paying due to sexual harassment. So if a business pays out a settlement, it is not deductible to the business if there is a sign non-disclosure. If that sexual harassment, all the details are made public, the business can deduct it. So to me, this is going to be interesting. You know, do they make it public and deduct it, or do they keep it private and get no deduction? Employers will receive a credit of 12.5% when they pay their employees more than 50% of their normal wages when they go on family leave. And this is for tax years of 2018, this year, and 2019 only. Businesses would get a deduction for transportation benefits in prior years. So this would be like carpooling, biking, and parking. But the new law says that these transportation fringe benefits are no longer allowed for the employer. But the good news is that they are still excluded from the employee's income if the employer is still paying for that. There are employee achievement awards out there, benefits for that. And employee achievement awards, basically the definition is they give a gift for, say, length of service and being in the company 10 years, 20 years, 25 years, or they give a gift for safety reasons. And the employee can earn up to $400. However, if there is a qualified, say, a written plan, the employee can earn up to actually $1,600. Any excess over these amounts is deductible to the employer, but they're also taxable to the employee. Now, here's what you need to know about the new rule. The IRS clarified what can be given for these awards, and they specifically called out what is not acceptable. So, for example, You cannot give cash. You cannot give credit cards, I meant gift cards. You cannot give a vacation or lodging or stocks. So I thought in my head, well, what is there to give? And so things that would be eligible would be, say, the typical watch or a clock, a pen, a plaque, a ring, something that you can order from a catalog, kind of think in that mode. So the old law was that publicly held corporations could pay their executives unlimited wages. This included like performance-based bonuses and commissions. Think of all the large corporations out there. CEOs are getting paid millions and millions of dollars for their wisdom in managing the corporation. But now the IRS says that these wages for compensation are limited to $1 million. Any amount over $1 million is not deductible. They give a clarification of what's called a covered employee. And the covered employee is actually a principal executive officer, principal financial officer. It's basically the top 3 executives in the company. And this new rule is actually interesting to me because, like I said, a lot of CEOs out there are paid millions of dollars. So it'll be interesting to see how this plays out in practical terms. If your company was $5 million or more in gross receipts, you were required to file your taxes on the accrual basis. However, the new rule bumps that amount up to 25 million. So just keep in mind, if you are 25 million or less, you can now file on a cash basis instead of an accrual basis. So let's talk auto deductions. Here's a great new rule. If you don't take a bonus depreciation for the first year for your auto, you can now deduct up to $10,000 to deduct your auto, where last year in 2017, the limit was about $3,100. So this is really good because it's actually 3 times more of a deduction that you can take for your auto if you don't claim that bonus depreciation in the first year. So here's a planning point that you're going to want to have a conversation with your tax professional. You know, what are the advantages of taking the full 10,000 now, or perhaps you spread it out over a period of 5 years because you're anticipating your income to grow over the next 5 years, or maybe you want to take the larger deduction now to get every tax deduction you can in this taxable year. So definitely seek counsel with your tax pro on auto deductions. Okay, so meals and entertainment. I think if there's one thing that's been in the news, people are typically aware about the new rules for meals and entertainment, but I don't think media is giving this a very clear explanation in English of what this really means. So let's go through this kind of line by line. So client entertainment at the top of this grid bar here. The prior law is you could take a deduction for entertainment. It was 50% deductible. But the new law, you get no deduction for entertainment. And a definition of entertainment is golf, movies, sporting events. So when we go down to the next line, client meals, the prior law, you got a 50% deduction. The new law says you still can have a deduction of 50%. But I just wanted to remind you, you need to have a quiet conversation about business, either before, during, or after the meal. You need to document who you had the meal with and the business purpose. What did you talk about? You cannot deduct your Starbucks morning coffee when you go out by yourself, and no, you can't cheat and write down the barista's name that took your order. No cheating that way. In an audit, the IRS is going to look for either the original receipt for that meal or a legible, readable copy of the receipt. And be aware, of those receipts that are thermal. They're going to fade after 2 to 3 years. And I will tell you, you can be audited, 4 years later. So if it's going to fade after 2 years, you may want to consider scanning receipts, uploading and linking that receipt to your QuickBooks Online. Expense there is an option for you. I was recently speaking to an IRS agent just last month, and he told me that the receipt that you sign and put your tip on is not good enough. You must have the receipt with the itemized food that you purchased. Otherwise, he said he's not going to take it as a deduction. So be aware to keep both the signed copy and the itemized copy of the receipt. Now, the next line down for employee travel meals, that didn't change. It's still 50% deductible when you are traveling for business overnight. The last line on the chart there is meals for the convenience of the employer. So if a company buys lunch for their employees and they are asked to work through a meal period, this was 100% deductible, but now it is 50% deductible. Let me give you an example. I'm a tax preparer. I ask my employees to work overtime through a meal period during tax season. This means that last year, if I brought in sandwiches, pizza, Mexican food, that would be 100% deductible to admin books. But this tax season in 2018, if I had done that, which I did, that meal is now 50% deductible, and you do have to offer it to all employees. You can't just say owners and managers get the meal. No, all employees need to be offered that meal. But what you may find interesting, I think it's interesting, my company is not in this situation, but for those companies that have an eating facility, say like Google, Facebook, LinkedIn, Intuit, their deduction for the eating facility actually is going to go to 0% after the year of 2025. So watch this category. I understand that the IRS wants to crack down on people taking advantage of, say, entertainment and meals and deducting things that may not really be deductible, and they're just putting their foot down on it. I totally get it. But know what's deductible, know what is still eligible and not eligible. So let me just make a clarification before we go to the next topic. We know that golf is no longer deductible, but the IRS in this new tax law clarified that if there was a meal during the entertainment, say you went to a ball game and bought a hot dog, that hot dog is no longer deductible, even though it's a meal. If it's done while entertaining, it's not deductible. But the good news is that the IRS confirms that holiday parties and annual company picnics are still 100% deductible. So that's really good. Be aware that what I'm talking about are IRS rules. They are federal laws. I just wanted to give you a reminder that this is not related to your state. For example, I am in California, and California actually allows entertainment expenses for now. Who knows if California will conform? Sometimes they'll change the rules come like October, November, so it's kind of a wait and see what California will do on entertainment expenses. So check your state to verify. So the IRS clarified that membership dues are not deductible for any club organized for business. Now, this is a new thing. So club dues, membership dues for business, pleasure, recreation, social purposes. This includes country clubs, athletic clubs, sporting clubs. Here's the exception. You still can deduct dues or membership fees for Chamber of Commerce, civic organizations, professional organizations, and trade associations. So that's good because you want to, continue in your trade or professional associations so you can keep up in your industry, but no deduction for anything that is social or recreational or pleasure. So let's move to what affects specifically C corporations. So Misty last week talked about alternative minimum tax for the personal returns, that many people, many taxpayers will be paying less in AMT on their personal returns. But for the corporate side of it, AMT, alternative minimum tax, is actually gone. No more AMT for corporations. The other good news is that C corporations are going to be paying now a flat tax of 21%. This is good for the most part, except those corporations that have income of less than around $87,000. They actually will be paying more. So look at your specific situation. I know that there's businesses out there that want to be a C Corp because they want to deduct medical benefits, which a C Corp is fabulous for medical benefits, but they're making a small amount, and yet they're going to pay 21% instead of the 10%. So not good for those section of the C Corp population. Now, good news for C Corps that are personal service corporations, because they used to pay 35% and now they're going to pay 21%. So good news for them. So basically, bottom line, planning is going to be key so that there are no surprises. You don't want to be that corporation that makes, say, $80,000 and want to have great medical benefits, but then end up paying 21% instead of 10%. The first thing, you need to know your situation. What is your situation? Is this you? Are you going to be paying more or paying less? And do get counsel from your tax pro. So I wanted to provide you a chart. So on the left, the corporate rates for 2017 started out to be 15%. It goes up to 39%, and then it fluctuates back and forth at the top, then showing 35%. And just for a gut number, you can see that 21% all the way down, no matter what your taxable income is for C corporations only. Now let's move to partnerships, and I just have 2 tips for partnerships. The first one is the old rule. When you had a partnership and you changed ownership of more than 50%, that partnership was actually automatically terminated. However, the new rule now eliminated this situation, so it does not happen anymore. So that's a good thing. The second thing that I wanted to bring up about partnerships is that you must designate a representative. If you do not, the IRS now has the power, if that's the right word, to select one for you. So they can select themselves, a banker, you know, somebody else in the partnership that maybe you do not want them to be the representative. So what you need to do is, if you are a partnership, you need to seek counsel from your attorney and update your agreement to make sure that the representative is clear in your legal documents. So I wanted to pause for a moment and talk through this slide. I wanted to give a hypothetical comparison. If a C Corp earned $100, if a pass-through entity earned $100, and what I mean by pass-through entity, I mean a Schedule C sole proprietor, an S Corp, or a partnership, or if an individual, say W-2 taxpayer, earned $100. So let's walk through this chart here. So for corporate, if they made $100, they would be taxed at 21%, as I mentioned. And the disadvantage in a corporation is there's that double taxation. You've probably heard of that, where if any dividends are pulled out, that's where it's double taxed there. So that's the dividend tax. Corporations are not eligible for a 20% pass-through, which we'll talk about in a moment. And then they don't pay any individual taxes. So the tax on a C Corp would be $39.80. For a pass-through company earning $100, they're not going to pay the corporate tax nor the dividend tax. They could be eligible for a 20% deduction, so that's $20. And then the pass-through entity, all the profits go to the personal return of the owners, where they pay tax on the individual level. So therefore, you can pay some individual taxes there. And so the total tax for a pass-through entity may be $32.64. For a W-2 wage earner, if you earned $100, there would be no corporate tax, no dividend tax, no 20% deduction. But if you paid the highest rate, which is 37%, you're actually going to be paying $40.80. So you can see here in this example, it is better to be a pass-through entity, or is it? And we'll talk more about that in a moment. I want to talk about the 20% deduction, which is a fabulous opportunity in this tax reform rules. And I am going to go through this very slowly and just give you an overview, but Sabrina will give you more details, will give you more examples, and talk you through this next week. And so if you haven't signed up for that webinar, do so. Okay, here we go. Hang on to your hats. So who is eligible for this 20% deduction? Pass-through entities only. So that means sole proprietors, Schedule C filers, S corps, and partnerships. The 20% is not eligible to C corporations. What is the 20% small business deduction? So let me give you a definition. The IRS is looking at something that's called QBI, Qualified Business Income. And it's basically for services like a service-based entity or somebody that builds widgets. It's also eligible for real estate, but it's not W-2 income. Now, where is this going to be deducted on the tax return? So the IRS has populated some draft 1040 tax returns. And as you can see on the screen, here's a draft form. On this draft form, you have your normal itemized deductions or your standard deduction on line 40. Then on line 42 is where the IRS is proposing to put the 20% deduction if your company qualifies for that. And then on 43, line 43 will be your taxable income, and then line 44 will be the tax that you will pay at the individual level. It is a draft. Most likely it will kind of stay in that area, but just wanted you to get a glimpse of that. Now, how will this 20% deduction be calculated? So when I heard it, I thought, okay, take the profits, multiply that by 20%, shazam, plug that into the return. Nope. Let me explain it a little bit more of how this is going to work. So pause for a moment and picture in your mind's eye two buckets, and these buckets represent businesses. In one bucket, the business is going to be a specified service business. Now, the IRS is giving us a definition of an SSB. An SSB is any business involving health, law, accounting, performing arts, consulting, which is a lot of people, athletics, financial services. It is not architects or engineers. And they added this kind of last minute to the bill. But think of all these industries, and the main part of a specified service business is where the main core of the business is, how do I say this? The main core is the skill that is done by the owner or the employee. So I'm an accountant. The core of our business is to provide tax returns and bookkeeping and payroll. And because it's done by me and my staff, that is qualifying for a specified service business. So that is one bucket. Let me give you some examples of how the 20% deduction is going to affect these industries. So here is a chart, and I want to walk you through the chart as best I can. So if you are a specified service business and on your personal return, if your total income, your taxable income is under $315,000 as a married couple, you will get the full 20% deduction. Now, if you are a single person, if your taxable income is below $157,500, you are going to get the full 20% deduction. Now let's jump to the bottom part of this chart. If you are a specified service business and your income is above $415,000 as a married person or above $207,000 as a single person, you will get no deduction. Now here's where my little star asterisk comes into play. This is where planning is super key. If you know you are a specified service business and you are over or you're close to $415,000, you are going to want to have a conversation with your tax professional and figure out strategies of what you can do to make sure you are under that threshold if you're close to the 415 or if you're close to the 315. Now, everybody that's in between the 315 and the 415 as a married couple, the single couple numbers are there. You are going to get a partial deduction. You're not going to get the full 20%. So if you're in between those numbers, you're going to get a partial deduction. Now, remember I said one bucket, specified service business. Now, if you are not a specified service business, there's another bucket. It means everybody else. So how is the 20% calculated for everybody else? This is where it becomes a little crazy, but I'm going to walk you through it. So what you need to know is you need to calculate the lesser of two numbers. The first number that you're going to calculate is QBI, qualified business income. That's the 20%. I want to say that's easy peasy, right? That's pretty straightforward. But what you have to do is step 2 is you have to calculate the greater of two numbers. So line A says 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of your unadjusted basis. Now, unadjusted basis is just a fancy way of saying what you bought the asset for. So if you bought an asset for $10,000 and you have depreciated it for 1 year, say $3,000, you're going to take the full $10,000 on that asset. So you're going to add that with 25% of your wages versus 50% of the W-2 wages that your company is paying out. So be aware, if you are a Schedule C filer, so proprietorship, and it's just yourself, there is no wages. So this is where you're going to have to look at your entity very carefully. You know, are you an S Corp and part of your wages is included in that calculation? Or are you a Schedule C sole proprietor and you have no employees and there's no W-2 wages? And be aware that when you do this calculation of the 50% and the 25%, it's the greater of those two amounts on line 2, but the lesser of that compared to the 20%. Now, if that isn't crazy enough, all other businesses actually have a limitation chart as well. And it's the same numbers that we talked about for the specified service business. So if you are not a specified service business and your income is below $315,000 for a married couple, then you do not need to apply this wage limit calculation. Fantastic. But let's jump to the bottom part of the chart. If your income is above $415,000 for married filing joint or $207,000 for a single person, then you must apply this wage limitation, and your preparer has to go through this calculation. It is not a simple calculation. I am basically giving you bare bones, simplified how this works. So anything in between, you're gonna have like a partial calculation, again, being complex. So if you are near those numbers, please be proactive and have a conversation with your tax professional. So I want to talk about your entity, because this plays a big part in planning for 2018. And every entity has its benefits and its responsibilities. I call, that's what my saying is: benefits and responsibilities, pros and cons. So a Schedule C is easy to set up, maintain, and close. Schedule C has a great home office deduction. You can be eligible for the 20%. The owners are not on, payroll, 20%, the W-2. The S Corp is a little more complicated to set up, a little more complicated to shut down, but you can be eligible for that 20%. It's a great liability protection. Obviously, you're going to check your attorney for liability protection for you specifically. But the owner, the officers need to be on payroll. So when you go from a Schedule C to an S Corp, it's a little different when you are on, you're an employee of your company. And then you also are required to have annual corporate minutes. So that's a responsibility you need to be aware of. Now, a partnership is pretty easy to set up, pretty easy to maintain. You are eligible for the 20%, but a partnership is subject to self-employment tax. And this is where the tax can really creep up there, and it's not always advantageous to be a partnership, and that's when some people want to switch to an S Corp, for example. A C Corp is going to have these lower tax rates, which are fantastic. You get medical fringe benefits. It's not going to have AMT any longer. It does have the double taxation. So as you can see here, a lot of pros and cons, benefits and responsibilities for every entity. And that's why your entity, your income number, to give you advice, it really depends on your entity, your income, and your goals of what you want to accomplish. So let me give you some examples here. And I'm not don't be overwhelmed with all these numbers, but I'm going to bottom line this for you. So in years past, a lot of times people would say, I'm making large profits, I am a Schedule C sole proprietor, and a lot of people would say, let's get you into an S Corp because it might be better for you to avoid that self-employment tax. But you want to be careful to just jump to any entity based on what your neighbor or coworker says. This first grid on the top is a calculation of an S Corp versus a C Corp in California, making $500,000 as taxable income. And I'm not going to go through the numbers there, but look at the bottom line. The S Corp is going to have a tax of $181,000, and the C Corp is going to have tax of $256,000. So in this situation, it's better to be an S Corp. But if you go down to the second little table there, it shows an S Corp making taxable income of $2 million versus a C Corp making taxable income of $2 million. And then go down to the bottom line there. It's better to be a C Corp. So again, it depends on your entity. It depends on your taxable income, on which one's going to be better for you. And do you need to make an entity change? Another point here is Schedule C. If you are a sole proprietorship with low income, it may not benefit you to be an S Corp and make that S election. Sometimes people would make the S election because they want to avoid large self-employment tax. But again, that's not always going to be the case. And I'll say it again, that you need to consult with your tax pro. So there are some great things happening for businesses with this new tax bill. AMT is gone, higher deductions for autos and assets, lower tax rates for corporations. Pass-through entities are going to get the 20% deduction that you didn't get in 2017. But as you can see in our presentation here, it's not going to be straightforward and simple. I will tell you that some of my colleagues that were planning to retire in 5 years, they're actually thinking that they're going to retire early. Why? Because this is complicated. It is not simple. And I just want to encourage you, get advice. You don't want to be surprised for 2018 taxes. Know the rules, have a conversation with your tax professional so that you know what to expect for that 2018 tax return. And that is the end of my presentation, and I'll switch it over to Sabrina.
All right, thank you, Renee. That was great. Just a reminder here, again, if you have any questions, I've seen a few good ones coming in, so we'll circle back to those. But if you have any questions, feel free to type them in the control panel there on the side, and we'll try to answer those before we end the webinar today. So feel free to do that in this next couple minutes if you haven't done so. And then just kind of wanted to remind you about, again, as Renee mentioned, the upcoming webinar that we have that goes a little bit more in depth on the 20% deduction. Obviously, it's a lot to kind of cover in a short period of time. So we'll try to expand on it a little bit more in that session. So looking forward to that one. So definitely register if you haven't done so. And then, as Misty mentioned, we also had the wonderful tax reform for individuals session that we recently had. So if you missed that, no worries. We do have the recording, so you can contact us, support@adminbooks.com, and we can get that to you. Okay. And then just a reminder that if you can, we're going to be sending out a survey afterwards, so we would love to have your feedback on how this webinar went, anything that you would like to see a little more of next time, any recommendations. We welcome any ideas that you have. So please do submit your feedback. We would really, really appreciate that. And then to add a little humor to everything, we like to kind of, even though taxes are so much fun already, we like to add in a little humor here. So we have, Dear IRS, I would like to cancel my subscription. Please remove my name from your mailing list. Don't we wish? Okay. And then also a reminder that we do have free stuff. Admin Books does have, actually, if you check out our website, we have several free items out there, or tips, information. We do have a newsletter that we send out periodically. If you're not on the list, please contact us. There's some really good articles out there that I know Renee sends out, and they're really, really great. So let us know if you're not on that list. And if you are looking for tax services, payroll services, bookkeeping help, please reach out to us. We actually have a process called Let's Get Acquainted, where we actually jump on a call with you and we kind of talk about our services, get to know your situation, determine if it's the right fit for each side. So if you're interested, please reach out to us and we can get that coordinated. And then of course our Facebook page plug here, there's the link. So again, some really good information we send out. Again, we put tips out on there and really good information. So be sure to check that out. And again, just kind of a short reminder here about what we do. We are, as Misty said, kind of a one-stop shop. So we do personal and business tax returns. We do tax projections. So if you're having an odd year, or something has changed and you really want to nail down expectations on tax liability and so forth, we do projections as well. Tax consultations. So if you just kind of want to jump on a 15-minute call and talk out something, or half an hour, we can do that. So if you'd like to schedule something, we do that as well. QuickBooks training, we have a really, really wonderful team of several QuickBooks experts. They're really good. So if you're needing some help on that side, we do that as well. And of course, payroll and monthly bookkeeping. So again, just a reminder there. And this is our contact information. So again, if you like to reach out, if you'd like some help with any of these services, you can call us at that number. We have our email address, taxes@adminbooks.com, website, and again, our Facebook link there. So, and so again, questions. We'll circle back to questions. And as I said, I think I saw a few good ones come in. So let's see what we have here. Renee, we did have a question. If you could just kind of reiterate about for businesses for Christmas parties or appreciation events for employees and the deductibility of that, has that changed? If you could just reiterate that.
Yeah, the good news is that has not changed. So what you can take advantage of is an annual Christmas party or a company picnic. Say in the summertime, you want to have a picnic at a park and kind of show employee appreciation. Those are still deductible.
Okay, awesome. And I think I did see a question with the increased limits to the vehicle depreciation. We did have a question about the kind of the rules regarding purchasing a company vehicle, and this was specific to an S Corp. And I just wanted to kind of address that one. I think it's more than anything, more than the entity type, it's important to just know that, you know, kind of to analyze whether it makes sense for your business. Because if you are, you know, if you think that you'll have a vehicle that's mixed use that you'll be using personally, it probably doesn't make sense to have it under the company, because then there are other rules that you are supposed to follow, including any personal use being added to your W-2 income, which, you know, you probably don't want. And so it can create additional complexity. So I think it's more, you know, dependent on your situation. I mean, does it make sense, you know, to have a company vehicle based on your business and kind of what you're doing? So I just wanted to address that one. And then we had a question about, is a contractor a specified service business? And Renee, I don't know if you want to touch on that.
Well, as a contractor, you are self-employed. So basically you have an entity, and most likely you can be a Schedule C filer, a sole proprietorship. You can be a S Corp, or you could be a C Corp as a contractor. So just kind of being careful of the definition. And then depending on the contractor, are you, building widgets? Or I would think that the question is maybe around, are you a consultant? Are you giving services? Is it your intellectual property? Are you, consulting and giving services? So you can be a consultant as any entity. You can be a contractor as any entity. So it just depends if you, build widgets and you're not a specified service business, but if you are a consultant, you are a specified service business and under those rules.
Yeah, and I was going to say, I agree with that. I think when you think about a contractor, I think it does depend, but a lot of those would be, I would think, kind of based on that person's skill and reputation. So, but I think, and there are a few questions in here that are specific about are certain types of businesses, would they be considered specified service businesses? And again, I think that's really the key point there is, and again, as we navigate this, we'll be able to kind of probably solidify this a little bit more. But I think it's really dependent on the situation, because you might have a certain type of business that in one respect could be, but then because of, the situation and, the owner's involvement and, different specifics there, it may or may not be. So I think it's hard to answer that without knowing really specifics to the situation. And we did have a question, I just wanted to touch on this one, regarding when you're looking at the 20% deduction, is it, if it's based off of a Schedule C, is it based off of gross revenue or after business expenses are deducted? So it's after business expenses. It's actually based on the profit, essentially. So I wanted to touch on that one, and let's see what else we have here. So I wanted to touch on this one. There's the question about real estate. And I know that with regards to the 20%, and Renee, I know you had mentioned that, that could possibly be included. I think it's important to kind of clarify that it needs to be a trade or business. So if you're not doing, if your rental real estate is not part of your trade or business, you're not doing that as your kind of main trade or business, you have, maybe you have a W-2 job, then it's not going to qualify for the 20%. So I think that's really important to clarify. Let's see here. And then I think this one, Renee, I think we can answer this one pretty easily. So regarding the joint filing and the 20%, does that mean it's actually better to stay under the $315,000? I think the answer is yes,
Absolutely.
right? Yes, and I think that's the thing that's confusing is, we talk about all these confusing thresholds and calculations you have to do, but if you're under the 315,000 married filing joint, whether you're a specified service business or not, you're going to qualify for the 20% straight. So that's where, again, as Renee said, planning is really important, because if you can stay under that, you don't have to worry about all of that extra calculations and limitations and phase outs and all of that. So
exactly. I think that's a great way to put it, Sabrina. Thank you.
yes. And let's see. And there was a question on here. Someone said that they did miss the first 20 minutes. Will they have access? So again, yes, we are recording this, and you will be able to get access to that recording afterwards. So just reach out to us and we can get that to you. Okay, and here's a question. Renee, do receipts for every business meal need to be kept, or only for meals over a certain dollar amount?
Great question. So what you need to do in an audit is build credibility with the IRS. And so if they ask for random receipts and you can provide them, your credibility goes up to here. So you're going to want to keep those. Now, the best thing to do is to copy the receipt and have those receipts. Do you want to elaborate on that, Sabrina?
I mean, I agree with you. I think so. And again, it seems like it's kind of tedious, but the more documentation, the better, I always say. And let me see, are gifts to clients fully deductible? If so, how should they be categorized? And I don't think, Renee, did we have any changes to those rules? I don't think so.
No, and the rules are you can give a gift to a client, but there is a limitation of $25 per person per calendar year. So if you give a $30 bottle of wine, $5 is not deductible, and you need to split that out on your financial statements and be prepared to document who you gave the gift to. If in an audit, the auditor is going to look at that and disallow, any gifts there.
Okay, great. That's what I thought. I didn't think it had changed, but and I think this is a really good question. And this has come up before, so I wanted to address it. So this person said they're an LLC filing as an S corporation. Are minutes needed? And I think we delved into this recently, actually. So no, there are not the same requirements if you're simply electing to be taxed as an S corporation. Those only apply if you're actually incorporated and taxed as an S corporation. So that gets a little bit confusing. So no, you don't have to worry about it in that case. And I think we're kind of winding down here. So let me see, maybe one more question here. Okay, so when you were referring to taxable income, does this income only refer to the W-2 income, or does it also include the income passed through in an S corporation? And I think, Renee, this is speaking of, again, those thresholds and those phase out amounts, and that is total taxable income, correct?
Correct.
Okay, yes. So it is when you're looking at those thresholds and you're looking at the 315,000 for married filing joint, you're looking at total overall taxable income. And I think that I think that about wraps it up.
Well, thank you everybody for your attention in our webinar. Thank you for your questions. Great conversation. I hope that you took one or two nuggets, you wrote them down and you can apply them to your situation and reap these tax benefits. If you have any additional questions, our contact information is in the handouts. And do sign up for the next webinar next Wednesday. And Sabrina will dive deeper into that 20%. She'll have some flow charts if you're still confused about it. Don't worry if you're confused about it. We will explain in English how to handle it. Just really appreciate you. Take good care, and we'll see you next week.
Thank you.
Bye.
Bye.